Think about this. 6 out of every 7 patients who desperately need a life-saving wearable defibrillator are currently, well, they're walking around without one.
Completely unprotected.
Right. Completely unprotected. They're clinically indicated for it. You know, the medical guidelines absolutely demand it, and yet they just leave the hospital with nothing.
It's a massive gap in care.
It really is.
Yeah.
So today we are diving into a company that is actively trying to fix that glaring gap in cardiovascular care. And they are delivering 66% quarterly revenue growth in the process.
Which is just a wild number.
Yeah, it is. So welcome to this Talk Tickers format deep dive. Whether you're currently holding the stock, maybe nursing a position you've had for a while, or you're just, looking for your next healthcare growth play. We are taking a whole stack of earnings call transcripts, analyst notes, and management commentary, and we're distilling them down so you are fully informed.
Yeah, and the goal with this specific format is really to just completely bypass the noise. Because every quarter, retail investors get flooded with, corporate speak, safe harbor statements, heavily massaged narrative.
Some old fluff.
Right. So our mandate today is to pierce through that. We are hunting for the real story that's hiding in the margins, the strategic shifts buried deep in the Q&A sessions, and the operational realities that actually move the needle for your portfolio.
Okay, let's unpack this. Today's specific target is Kestra Medical. Ticker symbol is KMTS. And we are dissecting their Q4 2026 earnings results.
A really fascinating quarter.
Very much so. Our mission is to cut through all the Wall Street jargon, pull the exact numbers, analyze the management's guidance for the upcoming year, and give you an actionable, highly opinionated bottom line on what this actually means for your portfolio.
So we got to start where Wall Street always starts.
Right, the baseline financial expectation.
Exactly.
The top line revenue growth here, like I said, is 66%. Q4 revenue hit $28.6 million.
Yeah.
And I mean, in the commercial stage medtech sector, seeing a revenue jump of that magnitude in a single 90-day period, that's a severe statistical outlier.
It genuinely is. I mean, when a medical technology company crosses into commercialization, you typically see this slow, grinding adoption curve.
Because doctors don't like to change.
Exactly. Doctors are inherently conservative. They do not change their prescribing habits overnight. So when you see a 66% top-line explosion like this, it signals that something fundamental is shifting in the market's adoption curve.
Like the friction is just gone.
Right. The friction that usually holds back new medical devices is being systematically removed by this company.
Well, let's look at what's actually driving it. If we zoom out to the full fiscal year 2026, their total revenue came in at $95.1 million.
Which is huge.
Yeah, that represents a 59% increase compared to fiscal 2025. And just to ground this financial data in, physical reality, that Q4 revenue was driven by 6,357 prescriptions for their flagship product.
The Assure system.
Right, the Assure system. That prescription volume is a 63% jump over the same period last year.
Just massive volume.
Yeah, and for the full year, they wrote 20,720 prescriptions.
Yeah.
Up 57%. But looking at those two sets of numbers, a deduction immediately jumps out at me.
Oh, the revenue versus prescription growth.
Exactly. Prescriptions and revenue are moving in lockstep, but revenue is growing just a little bit faster.
Right.
66% revenue growth against 63% prescription growth in Q4. So that implies they aren't just, pushing more volume. They either have established some serious pricing power, or they're just getting much better at collecting the cash from insurance companies.
Yeah, that slight premium on the revenue side, it tells a very specific story about their collection efficiency, which is, frankly, a massive hurdle in healthcare.
Always.
But before we get into the billing mechanics, just surface level, moving over 20,000 units in a single year proves this is no longer some niche early adopter product.
Right, it's mainstream now.
It is officially entering the mainstream clinical workflow. However, the top-line rocket ship usually obscures some messy financials underneath.
Oh yeah, and this is where retail investors often get tripped up.
Exactly.
Which is exactly where we need to apply some friction here, because the top line looks pristine, but I am looking at the bottom line, and frankly, I need to push back on the enthusiasm here.
Okay, let's hear it.
Q4 GAAP net loss was $38.8 million.
Yeah, it's a big number.
Now, management was quick to point out that this is an improvement from a $51.1 million loss in the exact same quarter last year.
Right, so it is improving.
But come on, it is still a nearly $39 million loss in a single 90-day period.
True.
And Their adjusted EBITDA loss, which, Wall Street loves to use to smooth out the ugly edges, that was $26.7 million. And their operating cash burn, like the actual literal cash walking out the door to keep the lights on, was $18.7 million for the quarter.
Yeah.
So explain this to me. How does a company lose nearly $39 million in a single quarter and have analysts calling it a strong result?
Well, it is the absolute classic tension in growth investing. It really requires a complete mental pivot from how we evaluate traditional businesses.
Okay, so how do we pivot?
It's deeply counterintuitive to look at a multi-million-dollar quarterly loss and interpret it as a bullish signal. I get that.
Yeah.
But you have to look at the underlying mechanics of their specific business model.
Which is what?
Kestra is not manufacturing a disposable widget, selling it to a hospital for a one-time markup, and then walking away. They are operating what is fundamentally a clinical rental model.
Okay, wait. So if I'm understanding this, their business is essentially enterprise SaaS, software as a service, but applied to physical hardware.
That analogy holds up perfectly, actually.
So they eat a massive upfront capital expenditure to build the device. But once it's built, the marginal cost to rent it to the third or fourth patient is where all the profit hides.
Exactly. Think about the life cycle of their Assure system. When a patient is prescribed this wearable defibrillator, Kestra doesn't sell the device to the hospital. All right. And they don't sell it to the patient. They lease it out for the duration of the patient's recovery.
Which is what, like a couple of months?
Yeah, typically a critical 60 to 90-day window when they're at an elevated risk for sudden cardiac arrest, usually following a heart attack or a new heart failure diagnosis.
Got it.
So Kestra retains ownership of the hardware. This means they have to pay all the upfront costs, to source the microchips, mold the plastics, build the internal software, assemble the garment all before they see a single dime of revenue from an insurance company.
Okay, well, that perfectly explains the GAAP net loss. Because generally accepted accounting principles require them to recognize all those massive manufacturing and infrastructure costs on the balance sheet, right?
Yes, depreciating over time.
You literally have to build the fleet before you can rent the fleet.
And that is precisely where the concept of operating leverage comes into play. I mean, in the early stages of building a massive national medical device rental fleet, your costs are astronomical compared to your revenue.
Right, because you're buying all the raw hardware.
Exactly. Buying hardware, expanding your sales territories into new states, building out 24/7 clinical support call centers.
It's a lot of overhead.
But once that specific Assure device is built and deployed to patient A, it comes back after 3 months.
Okay.
It gets cleaned, refurbished, its batteries are checked, and then it's immediately deployed to patient B.
Oh, I see.
The initial cost to manufacture it is a sunk cost at that point. So the incremental cost to rent it to that second, third, or fourth patient drops precipitously.
So every subsequent time that specific device is prescribed and goes onto a new patient, almost all of that insurance reimbursement just drops straight through the income statement to the bottom line.
Exactly right.
The gross margin on the third patient using a single device must be phenomenal compared to the first.
It really is, and we can actually see this operating leverage proving itself out in real time in the transcript.
Really? Where?
If you look at their gross margin, it is, without a doubt, the standout metric of the entire earnings call.
Okay, hit me with the numbers.
Kestra's gross margin expanded a massive 10.5 percentage points year over year to hit 54.8% in Q4.
Oh, wow, 10.5 points.
Yeah, and it also expanded 2 percentage points sequentially just from Q3. The chief financial officer, Vaseem Mahboob, explicitly noted that this is their 10th consecutive quarter of sequential margin expansion.
Wait, 10 quarters in a row?
10 quarters.
Where the profit margin gets better every single time they report.
Yep.
That is 2.5 years of relentless, methodical efficiency improvement. You rarely see that kind of unbroken streak, even in pure software companies, let alone a company dealing with physical supply chains and, hardware logistics.
It completely validates the entire underlying thesis of the business.
Clearly.
I mean, full year gross margin was 51.4%, which is up about 11 percentage points compared to the prior year.
Incredible.
The CFO stated this was driven by, quote, the unit economics inherent in Kestra's business model.
Which is that SaaS-like rental leverage we just talked about.
Right. And he also cited a decline in their cost per fit, driven by volume leverage and targeted cost improvement projects.
Okay, let's clarify that for the listener. The cost per fit is the actual logistical expense of getting the wearable garment fitted onto a new patient's body.
Yes.
Okay? Ensuring the electrodes have good skin contact, training the patient on how the alarms work, getting the system active, it requires human labor.
A lot of human labor, yeah.
And as they scale up the volume, their fitting network becomes denser and more efficient, so that cost drops.
Exactly. But the most crucial part for anyone trying to build a financial model for this stock isn't where the margin is today.
That's where it's going.
Right. Management is not stopping at 54.8%.
Yeah.
During the call, they reiterated their absolute confidence in reaching a long-term goal of 70% plus gross margins over the next few years.
70% on physical hardware.
Yeah. If you are an investor, you model that future 70% gross margin against a rapidly growing, multi-billion-dollar total addressable market, and suddenly that $39 million quarterly gap loss today looks like, well, a necessary temporary toll booth on the road to a highly profitable future state?
Yeah, that makes total sense. And the cash flow statement backs that up too.
It does.
You can see the actual cash burn is already shrinking, even as they grow.
Yeah.
I mean, they used $18.7 million in operating cash this quarter, which is down from $24.1 million in the exact same quarter a year ago.
Right.
So revenue grew 66%, prescriptions grew 63%, but the cash actually going out the door decreased by over $5 million.
That is the literal definition of operating leverage taking hold.
But look, having the best unit economics and the most efficient hardware lifecycle in the world means absolutely nothing if doctors aren't writing the prescriptions.
Absolutely true.
If the sales team fails, that beautifully depreciated fleet just sits in a warehouse gathering dust, generating zero revenue.
And that's exactly what we need to look at next.
Right. So we know they proved they can grow revenue at 66% while expanding margins. The obvious question for an investor is, how are they actually driving this adoption in the hospitals, and is it sustainable?
Let's look at the operational realities that drove these numbers.
Starting with their commercial expansion, what do they do there?
Well, the transcript shows that Kestra's management team was incredibly aggressive on the sales front during fiscal 2026.
So aggressive.
They entered the year with 80 active sales territories across the United States. They finished the year with 130.
Whoa, 80 to 130.
Yeah, that is a 62% increase in their commercial footprint in a single 12-month period.
Okay, we have to pause here because dropping 50 new reps into the wild is an operational nightmare for most companies.
Oh, it's incredibly difficult.
Building out 50 new medical device sales territories is not just dropping a pin on a digital map and running some Facebook ads. You have to recruit, hire, and train highly specialized representatives.
Right. People who actually know the science.
Yeah. People who can confidently walk into a chaotic cardiology department, speak the highly technical language of electrophysiologists, and actually change deeply entrenched, sometimes decade-old prescribing habits.
It's one of the highest friction sales environments on the planet. I mean, doctors are notoriously resistant to changing their workflows because a change in workflow introduces clinical risk.
Exactly. If it ain't broke, don't fix it.
Right, because if they prescribe a new device and the patient has an adverse outcome, the liability is immense. So a new sales rep has to navigate the hospital's value analysis committee, secure all the billing codes, and win the personal trust of the physician.
Which is why I seriously question the execution risk here. Expanding your sales force by 62% in 1 year introduces massive cultural integration risks.
It does.
How do we know management isn't just overextending their onboarding capabilities, bloating their SG&A selling general and administrative expenses without guaranteeing a real return on those new hires?
That is the exact right question to ask. But the proof is in the prescriber metrics they delivered.
Okay, what were the metrics?
If they were just bloating SG&A, we would see the territory count go up, but the revenue per territory plummet.
Right.
Instead, as a direct result of that footprint expansion, they reported a 55% increase in the number of new prescribers for the Assure system.
Oh, wow.
And a 65% growth in the number of ordering facilities.
So the new reps are actually converting new doctors?
Yes. They aren't just selling more devices to their existing fan base. They are successfully kicking open entirely new doors at hospitals that previously ignored them.
And there was a nuance in CEO Brian Webster's commentary that completely changes how you view their market share.
Oh, the part about the new WCD users.
Yes. He noted that a significant portion of these new Assure customers are entirely new prescribers of wearable cardioverter defibrillators as a category.
Right, which is huge.
They aren't just engaging in some zero-sum knife fight, stealing market share from the legacy incumbent. They're actually expanding the total addressable market by convincing cardiologists who historically never used wearable defibrillators to start prescribing them.
Yeah, and taking market share from a competitor requires a slightly better product, sure. But expanding a medical market requires changing the actual standard of care.
Exactly.
It means their sales reps are successfully educating doctors on the clinical blind spots in their current patient management.
Which is much harder to do.
But there is a second operational mechanism here that operates behind the scenes. It isn't as glamorous as a sales rep closing a new hospital, but it is just as vital to that 66% revenue growth.
Revenue cycle management, or RCM.
Yes, RCM.
I mean, in the software world, you just ping a credit card via Stripe and the money is in your bank account immediately.
If only it were that easy in healthcare.
Right. In the healthcare sector, RCM is an absolute labyrinth of prior authorizations, diagnostic codes, claim denials, appeals. It is often the difference between a thriving med tech business and bankruptcy.
It really is.
You can have 20,000 prescriptions written by enthusiastic doctors, but if the insurance companies deny the claims, you're essentially providing charity care, not running a publicly traded company.
Exactly. And the CFO spent a considerable amount of time highlighting improvements in their RCM processes.
What did he say?
He noted that their in-network payer mix is expected to remain securely in the low to mid 80% range for the coming year.
So for like 8 out of every 10 patients prescribed the Assure system, Kestra already has a pre-negotiated, legally binding, contracted payment rate with that specific patient's insurance company.
Yes. And that eliminates the most painful friction in healthcare billing.
The out-of-network fights.
Right. When the in-network mix is sitting at 80% or higher, it dramatically drives up what the CFO called the prescription fill rate, the bill rate, and the collections performance.
Ah, okay.
If you recall from earlier, we deduced that their 66% revenue growth outpaced their 63% prescription volume growth.
Yes.
This RCM efficiency is the exact mechanical reason why.
That makes perfect sense.
Because they are securely in network with the major payers, they're getting paid more consistently, faster, and at a higher realization rate for every single device they deploy.
They aren't spending 6 months fighting out-of-network appeals just to collect pennies on the dollar.
Exactly.
And the CFO even dropped a note that they're actively investing in revenue cycle AI tools and automation to drive that operating leverage even further.
Which is super smart.
Yeah, they want software handling the initial claim scrubbing and prior authorization checks, not, armies of human billers, which will obviously further reduce their SG&A costs as they scale.
So we have the commercial footprint expanding aggressively and the back office aggressively securing the cash.
Right.
But to truly understand why an electrophysiologist decides to completely change their workflow and write 20,000 prescriptions a year for a relatively new device, we have to examine the clinical reality.
Which is the core of it all.
Yeah, the earnings call was anchored by several clinical anecdotes, and they are critical to understanding the moat this company is actually building.
It's so easy to get lost in the margin percentages and the dead facilities, but the clinical reality is the absolute core of this business. The product exists to prevent sudden cardiac arrest.
It literally saves lives.
Yeah. It is literally designed to stop a patient from dying unexpectedly in their living room.
So let's break down the case study they presented from a leading academic medical center in the Southwest, because it perfectly illustrates how a single clinical event can completely override the psychological friction of adopting a new device.
Okay, lay it out.
When Kestra's sales rep first walked into this institution in March of 2025, the hospital had zero utilization of the Assure system.
Zero.
They used the competitor's device exclusively.
Right.
Fast forward 15 months, and that single hospital has gone from 0 to over 60 prescriptions, with 40 unique individual prescribers activated across multiple different medical specialties.
And the catalyst for that rapid hospital-wide adoption wasn't, a slick PowerPoint presentation or bulk discount. It was a high-stakes, life-or-death clinical event.
Yes.
The CEO detailed this on the call.
Yes.
A patient at this Southwest facility was prescribed the Assure system and sent home. While going about their day, that patient experienced ventricular fibrillation.
And we really should clarify what that means physiologically for the listener.
Yeah, please do.
Ventricular fibrillation, or VFib, is not a standard heart attack where a blockage causes chest pain.
Right.
VFib is an electrical complete collapse. The lower chambers of the heart stop pumping blood and instead just quiver chaotically.
It's terrifying.
It is. Within seconds, the patient loses consciousness. Without an immediate, massive electrical shock to reset the heart's pacemaker, the patient will suffer irreversible brain damage and die within minutes.
It's literally a race against the clock.
It is the most time-sensitive emergency in all of medicine.
And in this case study, the Assure system detected that chaotic rhythm instantly. It charged up, delivered a life-saving shock therapy to the patient's chest, and here's the real technological differentiator, their proprietary Assure Assist feature automatically transmitted the data and alerted emergency medical services before the patient's spouse even realized what was happening and could dial 911.
That part is incredible.
It is. Within minutes, the treating physician at the hospital received a notification on their phone with the patient's exact ECG tracing, allowing them to coordinate the trauma team while the patient was actively being airlifted back to the facility.
And that speed of integrated communication is exactly what separates a basic medical tool from a digital health platform.
It's not just a shock box anymore.
Right. It's not just a shock box sitting on a patient's chest. It is an active communication node. The CEO explicitly pointed out that this single event validated the entire platform for that hospital's value analysis committee and the cardiology board.
I bet it did.
It proved the therapy worked, but more importantly, it proved the clinical communication and the continuity of care worked flawlessly.
And the downstream business result of that single clinical success was immediate and profound. Within 1 week of that patient surviving, 4 additional Assure systems were ordered by physicians at that hospital who had never prescribed it before.
Word spreads fast.
It does. The CEO noted it even expanded beyond the initial electrophysiology service line. General cardiologists and heart failure specialists started prescribing it after seeing the clinical data integration and hearing about the patient experience in the doctor's lounge.
It creates an undeniable viral loop within a closed hospital system. I mean, one dramatic, documented success story spreads through the peer network faster than any marketing campaign ever could.
Oh, absolutely.
Suddenly, your Kestra sales rep doesn't even have to push the product. The doctors are actively pulling the product into their workflows.
And the CEO shared another story that frankly redefines what we think these devices are capable of.
The 43-year-old woman.
Yeah. He talked about a 43-year-old woman who was recovering from a severe myocardial infarction. 72 days after she was initially prescribed the device, while she was technically nearing the end of her high-risk window, she went into a life-threatening, sustained arrhythmia.
It's so scary.
She ultimately required 12 separate successful shock therapies from the Assure system to keep her alive through the initial event, the ambulance transport, and the hospitalization until the surgical team could finally stabilize her.
12 consecutive shocks.
12.
The physiological and battery demands of that are just immense. Most lay people think of a defibrillator as a one-and-done rescue tool, you know?
Right, you shock them, they wake up, problem solved.
But the CEO emphasized that the sustained multi-shock protection is a deliberate engineering design philosophy.
They planned for this.
They built the system to handle the absolute most complex, unpredictable, chaotic emergency scenarios, not just the textbook single shock events.
Which is vital.
And when a room full of electrophysiologists hears that a device successfully navigated a 12-shock scenario without failing, their clinical confidence in prescribing it to their most vulnerable, high-risk patients goes through the roof.
Yeah, anecdotes definitely move human behavior. But rigorous, peer-reviewed data is what ultimately changes national medical guidelines.
Absolutely.
Kestra is systematically building their clinical moat on multiple fronts. They aren't just relying on dramatic rescue stories.
Yeah.
They're funding massive data collection.
So let's examine the ACE-PAS study, because this is the data that will drive their growth for the next 5 years.
Right. So ACE-PAS stands for the Assure Post-Approval Study.
Okay.
It is currently the largest real-world prospective wearable cardioverter defibrillator study ever conducted, with over 21,000 patients enrolled and protected.
21,000. That's a massive sample size. It is. And we need to distinguish why a prospective real-world study carries so much weight. They aren't just looking backward at old insurance claims, which is a retrospective study.
Right, which is what a lot of companies do.
Exactly. They actually tracked 21,000 real patients in real time as they lived their daily lives with the device.
And the CEO noted that the data pouring out of this massive registry confirmed exactly what the early anecdotal patients were experiencing. The study proved exceptionally low false alarm rates, significantly higher wear time compliance, because the modern garment design is actually comfortable to sleep in.
Which is a big complaint with the old tech.
Huge complaint. And on top of that, a staggering 100% successful conversion rate of dangerous ventricular arrhythmias.
100% successful conversion.
Meaning every single time the algorithm determined it needed to deliver a shock to restore a dangerous rhythm back to normal, the shock worked.
That's incredible.
You literally cannot beat a 100% success rate in medical data. And this data isn't just sitting in a glossy brochure on Kestra's marketing website. It is actively moving the broader scientific needle in the cardiology community.
Which is arguably the most significant long-term clinical update from this entire earnings call. A newly published consensus paper in the highly prestigious Heart Rhythm Journal, which serves as the official publication of the Heart Rhythm Society, specifically cited Kestra's ACE-PAS study.
The Heart Rhythm Society isn't just a book club for doctors either.
No, they are the global governing body that literally writes the clinical guidelines that dictate standard of care.
Exactly.
If they say a therapy is required, insurance companies are forced to pay for it, and doctors are legally liable if they don't prescribe it.
Precisely. So the paper published in their journal was focused on the future landscape of sudden cardiac death prevention. And the CEO pointed out that this paper utilized Kestra's real-world data as contemporary evidence, demonstrating that patients maintain a persistent risk of ventricular arrhythmias, regardless of whether they have ischemic or non-ischemic cardiomyopathy.
Okay, let's translate the physiology there for a second.
Please.
Ischemic cardiomyopathy means the heart muscle is damaged because of a lack of blood flow, like a traditional heart attack where an artery is blocked.
Got it.
Non-ischemic means the heart is failing for other reasons, like a viral infection, genetics, or prolonged high blood pressure without a specific blockage.
So historically, the medical guidelines were very clear about using wearable defibrillators for ischemic patients, the heart attack survivors.
Right.
But the guidelines have always been a bit murkier regarding non-ischemic patients.
Much murkier.
But by citing Kestra's data, this heart rhythm paper recommends that clinicians should strongly consider WCD use for a much broader array of patients, including new non-ischemic heart failure diagnoses, while their medical therapy is being optimized.
And the CEO accurately called it a meaningful endorsement. It demonstrates that Kestra's proprietary data is being fundamentally incorporated into the global scientific dialogue.
It's a huge win for them.
Oh, massive. If this ultimately influences the official clinical guidelines to mandate WCD use for that broader non-ischemic patient profile, the total addressable market doesn't just grow incrementally, it practically doubles overnight.
And Kestra isn't even waiting for the guidelines to change before improving the tech. They announced an enhanced detection algorithm that was officially released and started shipping to all active patients in April 2026.
Yep.
The explicit goal of this software update is to further suppress their already industry-leading low false alarm rate.
Which is an absolute engineering marvel. Well, a false alarm means the device thinks the heart is fibrillating, but in reality, the patient is just brushing their teeth or driving over a bumpy road, and the movement is creating electrical noise artifact on the ECG sensor.
Oh, that makes sense.
If a wearable device constantly alarms loudly in public when nothing is wrong, or worse, delivers an inappropriate shock while the patient is fully conscious, the patient will simply take the garment off and throw it in the closet. And a $30,000 device sitting in a closet protects absolutely no one.
Right. The compliance rate is everything.
Everything.
The new algorithm uses advanced logic, likely a form of machine learning, analyzing impedance and baseline ECG patterns to filter out that movement artifact without missing a true arrhythmia.
Exactly.
By relentlessly driving down the false alarm rate, Kestra guarantees higher patient wear time compliance. Higher compliance drives better clinical outcomes in the data registries, which in turn drives more doctors to prescribe the Assure system over the competitor's device.
It is a compounding virtuous cycle fueled by software.
They also casually dropped a mention of a co-development project they entered into in mid-January 2026 with a company called BioBeat Technologies.
Oh yeah, that was interesting.
Right. The stated goal is to expand diagnostic insights for hypertensive patients. So they're actively trying to evolve the hardware. They don't want it to just be a therapeutic shocker that waits for an emergency. They want it to act as a continuous diagnostic monitor that gives cardiologists a stream of actionable data about their patient's underlying blood pressure and hemodynamics.
It's a brilliant strategy to deepen their integration into the hospital. I mean, if a doctor logs into the Kestra portal and can see not just arrhythmia risk, but continuous blood pressure trends, the Assure system becomes an indispensable daily management tool, not just an emergency parachute.
Exactly.
It differentiates them fundamentally from the legacy incumbent competitor.
So if we tally this all up, we have a rapidly growing commercial footprint expanding by 50 territories, a highly efficient billing department securing 80% in network rates, undeniable clinical validation backed by the Heart Rhythm Society, and an active pipeline of software and diagnostic upgrades.
It's quite the list.
But here's the reality of corporate finance. Funding all of this rapid expansion burns a tremendous amount of upfront cash.
It definitely does.
And that brings us to the final critical piece of the operational story, the debt refinancing.
Yes. This was a major strategic maneuver announced concurrently with the earnings release, and it completely changes the risk profile for a retail investor.
Let's hear it.
Kestra entered into a massive new $200 million term loan facility with a specialized healthcare investment firm called Pharmakon.
Right. And upon closing the deal, Kestra immediately drew down $75 million from that new facility. They used the bulk of that cash to retire their old existing debt facilities, effectively cleaning up their capital structure.
Okay.
But why does this specific $200 million loan matter so much to an individual investor trying to figure out if this stock is a long-term buy?
It matters intensely because it removes the greatest existential threat to a high-growth stock.
The liquidity wall.
Exactly. When a company is unprofitable on a GAAP basis, but attempting to grow at 66% a year, their biggest risk is hitting a liquidity wall. If they run out of money to fund the manufacturing of the rental fleet, they are forced to go to the public equity markets and issue millions of new shares of stock to raise cash.
Which dilutes everyone.
Right. That dilutes the ownership percentage of every existing shareholder, driving the stock price down. By securing this $200 million non-dilutive debt facility, Kestra essentially eliminates the dilution overhang. They have secured the capital they need without punishing their current shareholders.
And the CFO, Vaseem, highlighted a brilliant financial detail in how they structured this. By swapping out their old legacy debt for this new Pharmakon facility, they didn't just get more money. They actually reduced Kestra's cost of capital by a massive 24%.
A 24% reduction in interest expense on a multi-million-dollar loan is a staggering amount of cash saved every single quarter.
Right.
It speaks volumes about how institutional lenders view Kestra's risk profile today versus 3 years ago. As Kestra's revenue has exploded and their SaaS-like rental unit economics have proven themselves with 10 quarters of margin expansion, lenders no longer view them as a risky speculative startup.
Right. They view them as a safe bet.
They view them as a highly predictable cash flow engine.
The CFO stated this refinancing leaves the company with total liquidity of approximately $357 million.
That is a mountain of cash.
Yeah, that includes $262.2 million in actual cash and short-term investments sitting in the bank, plus the unused available capacity under this new term loan. Translation for the retail investor. Kestra is sitting on a mountain of cash. They possess absolute financial flexibility to execute their aggressive growth strategy, hire all the sales reps they want, and fund the R&D for the new algorithms without ever needing to come to the public equity markets hat in hand.
They have completely fortified the balance sheet against macroeconomic shocks. Even if interest rates spike or the broader healthcare market tightens, Kestra can afford to keep their foot firmly on the gas pedal.
Which brings us perfectly to the critical question of the future. They have the cash, they have the technology, and they have the momentum. But what happens when the law of large numbers finally catches up to this 66% growth rate?
Right. The growth has to slow eventually.
Did management give any indication that this hypergrowth is actually sustainable? Let's analyze their management guidance for the upcoming year and see what Wall Street is actually holding them accountable for.
So management provided their official fiscal year 2027 revenue guidance, setting the target at $137 million.
137.
Right. That represents a projected 44% increase over their fiscal 2026 revenue totals.
Now, 44% growth on a nearly $100 million revenue base is still incredibly aggressive in the medical device sector.
Very aggressive.
But what I found fascinating was the subtle tension during the Q&A session with the analysts regarding this exact guidance number. Matthew O'Brien, a senior analyst from Piper Sandler, essentially called the management team out on live audio for sandbagging their projections.
Oh, it was a fantastic moment of analyst pushback. O'Brien didn't just ask a generic question. He did the unit economic math live on the call.
Love when they do that.
Yeah, he pointed out to the CEO that the overall WCD market naturally grows in the low to mid-teens every year just based on demographic trends. Furthermore, Kestra is actively taking massive chunks of market share. O'Brien noted they took an estimated 4 percentage points of market share away from the incumbent competitor in fiscal 2026 alone.
Right, so O'Brien lays out the formula. If you add the baseline demographic market growth to Kestra's accelerated share taking, plus the compounding effect of the 50 new sales reps they just hired, the math strongly suggests their prescription growth should be significantly higher than the 44% revenue guidance implies.
The math wasn't mathing.
Exactly. He flat out asked the CEO, what are we missing here in the model? Is there a hidden competitive dynamic or a pricing headwind that is hurting you?
And CEO Brian Webster's response was incredibly telling for anyone trying to model the stock.
What did he say?
He firmly rejected the idea of any negative competitive dynamic. He essentially admitted, with a bit of corporate polish, that they are just intentionally lowering the bar.
Classic sandbagging.
Completely. His exact quote was, "It is us just being a rational management team. We want to make sure that as we get the year kicked off and we do absorb a lot of these new sales reps, that we set ourselves up for success."
Under-promise and over-deliver. It is the oldest, most reliable playbook in public markets.
Without a doubt.
You set a conservative floor for the stock and that you systematically beat it every quarter to generate positive headlines. But we need to examine the actual execution plan to hit, or likely exceed, that $137 million target. How are they deploying their resources to do it?
The primary lever remains their aggressive sales force expansion. In response to a specific modeling question from Rick Wise at Stifel, the CEO mapped out their territory goals for the new year. They plan to add approximately 40 additional sales representatives during fiscal 2027.
That would take them from 130 active territories to roughly 170 by the end of the year?
Yeah.
But wait, I have to challenge this logic. Where are they putting them? They already expanded by 50 reps last year. Is the United States really big enough to support 170 dedicated wearable defibrillator reps without them stepping on each other's toes and, cannibalizing their own sales?
It's a fair question. The CEO actually anticipated that exact concern and explained their two-pronged geographic approach.
Okay, what's prong one?
First, despite their rapid growth, there are still completely uncovered geographies in the U.S. market, entire secondary cities and rural hospital networks, where Kestra simply does not have a human being present.
Really?
Yeah, they are leaving obvious money on the table in those areas. Second, and structurally more important, they need to actively split up their highly successful, high-volume territories.
Wait, break down the mechanics of splitting a territory. Why would a successful rep want their territory cut in half? That usually means less commission.
The CEO gave a great hypothetical scenario using a major metropolitan area like Chicago. Imagine Kestra's first rep in Chicago is an absolute rock star.
Okay.
They hustle, they educate, and they manage to open up 20 different major hospital accounts. Technically, on a spreadsheet at corporate, Kestra has coverage in Chicago.
But in reality?
The reality on the ground is that one human being cannot effectively service 20 high-volume, chaotic cardiology departments.
Oh, they burn out immediately.
Exactly. They can't do the necessary fellowship education programs for the young doctors. They can't handle the continuous nursing staff in servicing, and they can't manage the complex patient onboarding at that massive scale. The service quality begins to degrade.
Got it.
So as the territory matures and the prescription volume spikes, Kestra will add a second, third, or even fourth rep to that single city to deepen the penetration and maintain the clinical service level. The CEO noted it will likely take another 2 full years of hiring to reach what they consider full coverage of the U.S. market.
That is the textbook definition of a land and expand enterprise strategy. You land the initial account with one rep and you expand the footprint with a whole team.
Right.
But there is a crucial clinical warning the CFO issued regarding how this revenue will actually materialize on the income statement throughout the year.
Yeah.
If you are building a quarterly financial model for this stock, or if you are trading short-term options, you absolutely must factor this in.
Yes, the CFO, Vaseem, was exceptionally explicit about the ramp time for new commercial hires.
What's the ramp time?
Well, when you hire a new medical device sales rep, even a highly experienced one, they do not generate peak revenue on day one. It takes months to build local relationships, navigate complex hospital purchasing committees, and slowly change physician prescribing habits case by case.
A slow burn.
Vaseem stated there is a standard modeled 6-month ramp period for any new representative to reach full commercial productivity.
A 6-month operational lag.
Exactly.
So the 50 reps they hired in the back half of fiscal 2026 are only just now hitting their full stride and generating peak revenue as we enter Q1 of 2027. And the 40 new reps they plan to hire throughout this year won't hit their peak productivity until the second half of 2027 or early 2028.
Exactly. When pressed by an analyst on how to model the cadence of the upcoming quarters, Vaseem actively steered the street to expect revenue growth to accelerate much more heavily in the second half of fiscal 2027 compared to the first half.
Okay, that's crucial for modeling.
The revenue growth curve will steepen dramatically as the year progresses, and the newly expanded 170-person sales force fully comes online and exits their training phase.
But we also have to talk about the massive elephant in the room that came up during the Q&A portion.
Oh, the competitor.
Yeah, the competitive landscape. Kestra is taking 400 basis points of market share, but who exactly are they taking it from, and how is that incumbent responding?
Well, while management is always careful not to explicitly name the competitor in their prepared remarks, analyst Michael Polark from Wolfe Research brought up a highly specific and honestly damaging piece of industry news.
What was it?
He noted that Kestra's primary legacy competitor recently received a formal warning letter from the FDA.
Whoa. We need to contextualize this for investors who don't follow regulatory affairs. An FDA warning letter is a massive, flashing red flag in the med tech industry. It typically follows a Form 483, meaning the FDA physically inspected a manufacturing facility and found significant systemic violations of quality control or regulatory requirements. It is not a minor paperwork error. It threatens their ability to sell products.
Right. Now, Polark noted that the public details of the warning letter seemed focused on the competitor's external AEDs and ventilator components, not explicitly the competitor's WCD division.
Which the CEO later casually referred to as their life vest business.
Right. But Polark's question was pointed and strategic. Does this massive FDA regulatory distraction for the incumbent strengthen Kestra's competitive position in the field?
And CEO Brian Webster gave an absolute masterclass in corporate diplomacy while simultaneously just, twisting the knife into his rival.
He really did.
He said, quote, "Anytime there is regulatory actions in the industry, you would be wise to pay attention. Most large medtech companies try and standardize their quality systems across all their divisions. So I'm sure our competitor is heavily evaluating their quality systems across the board to make sure that contagion doesn't spread."
It is a devastatingly brilliant point. Even if the FDA warning wasn't explicitly for the competitor's WCD division, managing a severe FDA crisis drains massive amounts of corporate resources.
So much time and money.
Executive attention is hijacked, legal fees skyrocket, remediation protocols slow down manufacturing, and overall brand equity takes a hit in the eyes of hospital purchasing administrators.
Right.
While the competitor is locked in conference rooms fighting regulatory fires and dealing with FDA auditors, Kestra is dropping 40 new hungry sales reps into the field and launching enhanced machine learning algorithms.
The momentum shift is completely palpable. And the competitive advantage goes even deeper than just a regulatory distraction.
Right.
Earlier in the Q&A, another analyst asked about the competitor's recent attempt to launch a slightly updated new product.
Right.
The CEO essentially dismissed the competitor's new device as purely incremental, not transformative. But more importantly, he highlighted a structural, economic reality of the WCD market that heavily favors Kestra right now.
Oh, the fleet replacement cycle.
Yes, the reality of the fleet replacement cycle.
This circles all the way back to our very first discussion about the SaaS-like rental model. The competitor has been a monopoly for years. They have a massive entrenched fleet of thousands of older legacy WCD devices circulating in the global market.
And they own all that hardware.
Right. Even if they launch a marginally better, newer device today, they cannot afford the catastrophic capital expenditure of instantly throwing away their entire existing fleet and replacing it overnight.
The depreciation hit to their balance sheet would be fatal.
Absolutely fatal.
The CEO estimated it will take the competitor 3 to 5 full years to slowly, methodically roll out their new product and retire their old fleet across the country.
Which means a massive tactical advantage for Kestra. For the next 3 to 5 years, when a Kestra rep walks into a hospital to pitch the Assure system, they are largely competing head-to-head against the older, clunkier generation of the competitor's technology, not the new stuff.
It's an open goal.
It gives Kestra an incredible multi-year runway to continue aggressively capturing market share while the incumbent is literally trapped by their own legacy hardware.
Okay, let's step back and look at the whole board here. We have dissected the explosive headline financials, we've explored the operational and clinical stories driving those numbers, and we've mapped out management's guidance and the competitor's regulatory stumbles.
We have all the pieces.
We have all the pieces of the puzzle, which brings us to the climax of this Talk Tickers deep dive. The bottom line,
Drum roll.
we have to synthesize all this data, all these narratives, and all the Q&A subtext into a definitive, actionable stance for the retail investor. So I'm going to put you on the spot and ask you directly.
I'm ready.
What does this all mean for the listener?
Yeah.
Based on this comprehensive Q4 2026 earnings call, are we flashing a bullish or a bearish signal on Kestra Medical?
I am taking a firm, unequivocal, bullish stance on Kestra Medical.
Okay, Bob.
And I'll tell you exactly why, by synthesizing the core arguments. The fundamental thesis for owning the stock relies on 3 unshakable pillars: the market opportunity, the flawless execution, and the fortified financial foundation.
All right, let's cement those pillars for the listeners. Start with the macro market opportunity.
Early in the call, the CEO casually dropped a statistic that should be the absolute center of every single investor's thesis on this company. Currently, 6 out of 7 patients who are clinically indicated by medical guidelines for a wearable cardioverter defibrillator are not protected by one.
It's just wild.
Let me repeat the magnitude of that failure in care. 6 out of 7 patients who should have this life-saving device do not get one. The market is massively structurally underpenetrated. The CEO accurately noted that the category is merely in the early stages of becoming a multi-billion-dollar standard of care market.
Which means it's not a mature, saturated market where Kestra has to fight tooth and nail for every single point of share in a brutal zero-sum game.
Not at all.
The ocean they're sailing into is vast, highly lucrative, and largely empty of competition.
Exactly. Yet, despite the massive unpenetrated TAM, Kestra is still successfully taking direct market share from the legacy incumbent.
4%, right.
Yes. They snatched an estimated 4 percentage points of market share in fiscal 2026 alone. They are beating the competitor head-to-head in the established accounts while simultaneously expanding the overall market by converting entirely new prescribers who have never used a WCD before.
Okay, that covers the massive market opportunity. What about the second pillar, their operational execution?
The operational execution is practically flawless. They are delivering 66% top-line revenue growth on a large base. They have successfully expanded their highly specialized sales territories by 62% in a single year without breaking their culture.
That alone is impressive.
And they simultaneously improved their revenue cycle management to secure an 80% in-network payment mix, ensuring they actually collect the cash they bill. But the ultimate undeniable proof of their execution is the gross margin.
The 10 quarters.
Right. Expanding gross margin sequentially for 10 consecutive quarters proves mathematically that management knows exactly how to scale their complex rental model efficiently. They aren't just buying hollow revenue at a massive loss. They are methodically marching toward a highly profitable 70% gross margin profile.
And the third and final pillar, the financial foundation.
They have fortified their balance sheet with absolute precision to survive any macro environment.
The $200 million loan.
Yep. By securing the $200 million Pharmacon debt facility, reducing their overarching cost of capital by a massive 24%, and exiting the quarter with $357 million in total available liquidity, they have entirely removed the near-term risk of shareholder equity dilution.
They have plenty of runway.
They possess all the cash they could possibly need to fund the 40 new sales reps for 2027, weather the 6-month productivity ramp-up period, and continue aggressively investing in massive clinical data registries like the ACE-PAS study to drive further Heart Rhythm Society guideline adoption.
So, to synthesize all of this into a final actionable takeaway for you, the listener, if you are a growth-oriented investor who can stomach the volatility of a company that isn't fully profitable on a strict GAAP basis quite yet, this is a textbook land and expand medtech play.
It really is.
They have the superior clinical tech, validated by the highest echelons of peer-reviewed journals. They have a massive, underpenetrated total addressable market. They are demonstrating absolute textbook operating leverage, and they have $357 million in liquidity to back up their ambitions. If you believe in the financial transition from a traditional hardware sale to a high-margin, SaaS-like clinical rental fleet, Kestra Medical is executing the playbook perfectly.
But before we officially wrap up, there is one last, slightly hidden, incredibly provocative nugget from the very end of the Q&A session that I want to leave you with.
Oh, lay it on me.
Because this is where the long-term story gets really interesting. When the analysts were pressing CFO Vaseem Mahboob and CEO Brian Webster on exactly why they structured the new $200 million debt facility the way they did, it was revealed that they specifically negotiated and baked an uncommitted M&A tranche into the final agreement.
Wait, M&A meaning mergers and acquisitions?
Yes.
So they specifically secured a dedicated line of credit uniquely designed to go out and buy other companies.
Exactly. Now, the CEO was very quick to caveat this for compliance reasons. He claimed that nothing is imminent and there isn't a specific deal sitting right in front of them on the desk.
Sure, they always say that.
Right. However, his exact words on the transcript were, "We are building a first-class direct cardiology sales force, and we want to take advantage of that channel. If there is new technologies that we can bring to the table that can be additive for our clinical partners, we are going to be very interested."
Oh, wow.
He concluded that thought by saying they are actively leaning in to the Kestra story.
That is a massive tell for Wall Street.
Mm-hmm.
I mean, you do not spend months negotiating an uncommitted M&A tranche into a 9-figure debt facility unless your corporate development team is actively looking at acquisition targets.
No, you absolutely don't.
Let's look at the leverage they have built. They have spent the last few years meticulously building a 130-person, soon-to-be 170-person, highly specialized elite sales force. These reps have deep personal relationships in the cath labs, the electrophysiology suites, and the heart failure clinics across the entire country.
Yeah.
But right now, those 170 reps only have one major product to pull out of their bag to sell, the Assure WCD system.
Which leads to the final provocative thought we want you to mull over as you analyze this company.
What's that?
Once Kestra establishes full geographic coverage of the United States and fully entrenches the Assure system into the standard hospital care pathways, what piece of cardiovascular technology might they acquire next to drop into the bags of those 170 sales reps?
That's the billion-dollar question.
Yeah. Could it be a revolutionary AI-driven ECG analysis software? Could it be a continuous remote patient monitoring patch for heart failure? With a massive, highly efficient direct-to-cardiology distribution channel now firmly in place and the sheer financial firepower to execute acquisitions, Kestra may be positioning itself to build an absolute monopoly on the entire cardiac recovery workflow, moving well beyond just wearable defibrillators.
Now that is a structural shift to ponder as you watch the healthcare space evolve this year. Thank you for joining us on this Talk Tickers deep dive into Kestra Medical. We know your time is money, and we hope the time you spent with us today breaking down the real mechanics behind the earnings call leaves you significantly better informed and ready to make your next move in the markets. Until next time, keep diving deep.